Hi, everyone. Welcome to my March market update video. I appreciate you joining us today. We're going to talk about the elephant in the room and the recent bank failures that we have seen, what it means for investors, whether or not we may be at a turning point for the stock market. And we're also going to talk about the bigger picture, where the economy was prior to when the news broke about Silicon Valley Bank last Thursday, where the economy was potentially headed. And whether or not this signals a potential change of course for you. First off, I appreciate you tuning in today, as I know many of you may be watching this video for the first time. I'm Valerie Leonard, CEO of EverThrive Financial Group, and these monthly market updates are part of our firm's commitment to proactively communicate with our clients because we want them to be informed and to make informed decisions. And before we get started, I just want to remind you that you can subscribe to our YouTube channel or our social media sites if you'd like to stay up to date on our latest research. Today is the evening of Monday, March 13th, just so that you'll know some of the data in this video is based after the close of business today. So first off, prior to March 10th, when we saw the closure of Silicon Valley Bank, I saw the market being at a pivot point even before all that happened. And you yourself may have been optimistic. You may have seen optimistic headlines saying that the worst was behind us because sentiment really started to turn positive. With nearly 2 decades of professional investment management experience, I actually found myself questioning the optimism because one thing I know to be true from the prior economic recessions we've seen is that bear markets don't just die. They typically need a catalyst to flush all the junk out of the system. So you may recall, if you saw my video last month in February, I mentioned that I was concerned about the deterioration of creditworthiness and that we might see delinquencies increase for both consumers and for companies alike. And that's just what we've seen last week with the announcement from Silicon Valley Bank. I also mentioned that markets were still technically in a downtrend in my video last month, and that it wouldn't be unreasonable for markets to reverse course. Again, that's what we're seeing now. So this is certainly an unusual time where economic indicators and stock market activity are adding up to multiple possibilities. Overall, the economy is still on decent footing, but the markets are starting to show the cracks that many of us suspected may have been there over the last year or so. So let's dive right into what I'm watching at the moment. Before we talk specifically about Silicon Valley Bank and others, let's take a step back to help us understand what prompted the bank failure. So as investors, we are looking to buy companies with innovative and reputable products or services, with solid leadership, with robust fundamentals, and the potential for strong future cash flows. And when we buy a company, we're doing so because we believe that that company will be worth more in the future than it is today. And we're willing to invest with the hopes that we will receive a future return. So having said this, because money has flowed so freely since the start of the pandemic, we've seen many what I call phantom companies pop up. And these companies often have investors who are willing to pay big money and place big bets on these companies' futures because they have a cool idea or product. But many times they don't have a proven proof of concept or even experienced leadership. And these companies often don't have the financials to back up the amount of money being thrown at them. And this is particularly true in the technology sector. So let's talk about March 10th and what caused Silicon Valley Bank to fail. The bank made headlines since its customers started feeling a cash flow crunch, and they wanted to make sudden withdrawals. And so the company did have assets to back up the withdrawal request, but the assets could not be immediately converted to cash. So what happened was they ran into a liquidity problem. And the bank had made longer term investments, and in most cases, prudent investments. But because the Federal Reserve has increased rates so rapidly recently, their long-term investments were worth less. And so when customers started making sudden withdrawals, the bank had to sell its assets at a loss. And then from there, investors who owned Silicon Valley Bank stock lost confidence and they started dumping the stock. This was on March 9th, March 10th, and that drove the stock price down. And of course, it drove the company's overall value into the ground. So the FDIC stepped in, they took control of the bank, they reassured customers that their insured deposits would be made available within a few days. So in the end, a lack of liquidity was the real culprit. It was a similar story for Signature Bank, except they had a high exposure to cryptocurrency, which is, of course, even more speculative. And then the Fed and JP Morgan stepped in with additional funding to help stabilize First Republic over the weekend as well. But that didn't stop First Republic's stock price from falling nearly 62% today, Monday. So this just shows how much fear and uncertainty is out there right now, but it doesn't mean that you should panic about your bank. What I would encourage you to do is review your balances. Make sure that you're covered by FDIC insurance. So the limit is $250,000 per depositor per bank. So if you own a joint account, both depositors can take advantage of this coverage and have a combined limit of $500,000 in FDIC coverage. Now, let me also acknowledge that many investors seem to be confused at the moment. Are we in a recession or not? So oddly enough, economists themselves are conflicted with the majority of them hedging their bets and saying that there's a 50-50 likelihood of going further into a recession, according to this February survey. So a 50-50 chance doesn't provide a lot of guidance or even confidence about what's ahead. I do want to start by resharing the slide from my February market update presentation because it really highlights the shape that the consumer is in right now and the fact that we could see an increase in delinquencies on the debt that Americans hold as well. We're going to talk a little bit more about this here in just a minute, but this survey shows that almost half of millennials say that they run out of money during the month and that they need to rely on credit cards or family members to help close the gap. Will this bank failure that we've seen out of Silicon Valley Bank, out of Signature Bank, will this lead to other bank failures? Is this a systemic risk, basically? So I know that this feels reminiscent of 2008 for many experienced investors. And events like this, of course, can stir up many, many emotions. And while this is certainly a big deal, and only time is going to tell how other banks will fare, we do know that the U.S. banking system is very well capitalized on the whole right now. The circumstances are different than they were in 2008, despite what the media might lead you to believe. Silicon Valley in general is known for innovation and startups. Their customers tend to take more risk in general. Startups and these venture capital backed phantom companies that I mentioned earlier just inherently carry more risk. So it stands to reason that only banks with exposure to high risk areas may themselves be at risk. But this doesn't mean that all banks across the board are at risk. So we'll be watching closely this week to see whether the fear spreads. But at this point, there's no reason to believe that the recent bank failures will take us back to 2008 levels. As a matter of fact, banks are more transparent than they were back then. Like I said, they have more capital to help them weather a crisis. And the Treasury announced Sunday that they are committed to help provide a way for banks to borrow against long-term asset losses that these banks may have on their balance sheet. So while this doesn't make their problems go away, it does give them more time to work things out. A few other notes on economic factors that investors should be aware of. So inflation is still a factor, but we've experienced a tale of three inflations. We first saw inflation from supply chain issues, which were coupled with a surplus of consumer savings. We then saw inflation creeping into things to services things like travel, entertainment, dining out. And then third, now we're seeing shelter inflation. And literally the costs associated with living in your home are where we're seeing, the highest inflation rates. You can see the difference between shelter inflation and other types of inflation on this chart. So the straight line with the yellow arrow pointing to it is the shelter inflation line. So from March 2022 to February 2023, the red line is inflation once shelter inflation is removed from the calculation. So you're going to hear people say that inflation is getting better, and then you're going to hear other people say it's getting worse. And both can be true depending on which line here you're referring to. Prices for non-shelter items stabilized last summer, and some have even dropped while shelter inflation continues to rise. So this week's inflation report, due out, I believe, on Tuesday or Wednesday, will provide some valuable insight after such a volatile week in the bond market. So that will, of course, be something to watch. Now, moving on to employment news, the latest job report was better than expected and indicates that the labor market remains healthy despite layoffs in the tech sector, and that the total unemployment rate also fell in February. So consumers continue to spend. We saw personal spending, retail sales both surpassed analysts' expectations as well. This bar at the far right represents the January jobs report. Overall, the labor market remained strong in February. We saw 311,000 jobs that were added in February. So despite faster than expected hiring, average wage growth increased less than expected. So that's something to watch. What are people earning? So wage growth increased less than expected. So as we always point out, unemployment is a lagging indicator. We'll take this news with a grain of salt. We'll continue to watch it. Something else that bears watching is consumer behavior. I mentioned debt earlier. Debt is growing for the consumer. In fact, the end of last year, credit card balances rose 15%. That's a bigger increase than any other point in the last 20 years. So while the jobs report sounds promising, consumers really drive our economy. And it's important to monitor whether or not they're spending responsibly. So this is something, again, we'll be watching closely. In last month's video, I reminded you to keep an open mind about worse than expected market outcomes, even though conditions at the time seemed to be improving. And as a matter of fact, when we experience bear markets like we're seeing right now, it typically isn't until the junk is flushed out of the system that the market can find its legs and start to recover. While recent events are certainly very, very unfortunate. I actually see this bank failure out of California, Signature Bank, out of New York, as a positive for markets over the longer term, because if the junk is hauled away, that gives markets a cleaner path forward. Is the process painful? It certainly can be. And this is where working with an experienced advisor who has a history of navigating similar markets is important. After having lived through the dot-com and the great financial events, I believe you have to have a solid process and risk management strategy in an environment like this. And I also reminded you last month about the importance, like I said, of staying flexible, and that is certainly critical as well. Markets could recover quickly, or we could see more sell-offs. And I would recommend being prepared regardless of which direction this market heads. Some final thoughts here. We cannot control the market or the economy, but we absolutely can control our decisions, we can control our behavior, and we can control our emotions. When I see investors make mistakes, it's often because they allow their emotions to dictate their decisions, and they don't have a process that incorporates time-tested strategies for times like what we're seeing right now. So I'm not saying that you just hold on and let the ride take you wherever the market goes. What I'm saying is stay agile and evaluate your options. My best advice at this point is to reassess how much risk you want to take going forward and adjust your portfolio accordingly. The U.S. stock markets have a history, of course, of increasing over the long run. But the question is, are you comfortable with more volatility that we are likely to see? And if not, you may want to consider taking some risk off the table. If you do decide to take risk off the table, you need to do so strategically, because in the midst of so much pain, there really could also be some good buying opportunities at some point. And since no one knows exactly when that might be, the key, again, is to have a disciplined investment process that helps take the emotions out of the equation. If you work for a company who is partnered with EverThrive Financial Group, to manage your 401k plan and you're not sure whether you should be doing something different within your own 401k account, I'd like to invite you to take a risk assessment to help us determine how much risk is appropriate for you and whether changes may be needed. So if you want to take that risk assessment, just email us at info@everthrivefinancial.com and we'll see where you stand when you take the assessment and whether your account aligns with the results. And we'll have a conversation about what you should potentially do next. And then for those clients who have partnered with us for investment management, where we have discretionary management authority over your accounts, unless your tolerance for taking risk has changed, just know that we're closely monitoring conditions. We're adjusting portfolios when appropriate. We're keeping our eye out for opportunities for improvements. I do have some cautious optimism potentially about third and fourth quarters of this year. But of course, we're watching everything very closely. And if you have questions or you want to review your portfolio, don't hesitate to reach out. So that's it for our update this month. But know that we are always here for you. We're happy to speak to you about your own situation. Don't forget to subscribe to our YouTube channel. And thank you for joining us today. We will see you again soon. Keep in mind that this presentation is intended for informational purposes and should not be construed as actual investment advice because the content doesn't consider the personal situations of each respective viewer. For this reason, we always recommend you consult a qualified professional before investing and have a conversation with us offline if you have questions.